in a series of repercussions, starting with sanctions. It's impacted the global economy in more ways than we actually realize. Supply chains have been affected. Food prices have touched a sky high. Energy has become more expensive. Countries have tightened their monetary policies. The combination of all of this, along with COVID, has resulted in fears of a recession, and a recession that could really devastate the global economy this year in 2023. Now, what's a recession? It is a period of economic decline, and it typically lasts 2 quarters or more.
Are we in a recession? For now, many economists agree that we are not in a recession. The most recent gross domestic product report published last week showed the U.S. economy grew by 2.9% in the fourth quarter of 2022, following growth of 3.2% in the quarter before. That's more than enough to overcome one technical definition that a recession equals 2 consecutive quarters of negative growth. But the same economists still foresee a mild recession's hitting soon. In the midst of recession fear, let's look back and see what actually happened in 2008, the Great Recession. It was the late 1900s, internet-based companies were seeing tremendous growth and their stocks were skyrocketing. This led to a lot of investment from investment banks and created a lot of speculation in the tech industry. Everybody was pouring money into the companies' names that have .com at the ends and making significant profits. This was the .com bubble. However, in the early 2000s, the bubble eventually burst. Slowly investors realized that these internet companies do not have any cash flow and are not making any profits, leading to a sharp drop in tech stock prices and a decrease in overall confidence in the stock market and the growth of the economy. The growth of the economy is hardly moving and signaling a recession. At the same time, banks were looking at safer investment ideas. To overcome the situation, the Federal Reserve decreased interest rates to an all-time low of 1%, making it easier for individuals and businesses to borrow money. With the low interest rates, the rate of spending also increased and recovered confidence in the U.S. economy. With no systemic problems in the economy and the low interest rates, the recovery of the economic growth was rapid. Eventually, the speculation from internet companies and stocks moved towards real estate. By 2003, everyone with a good credit score and a steady income already owned a home. If you are in the business of giving home loans, this was a bad sign. To increase their profits, these businesses relaxed credit scores to attract more and more customers and make significant profits. These were called subprime loans. As the money flowed in and time went on, the standards of money lending got lower and lower. If the subprime customer defaults, it was not a problem. You have property to sell and make profits.
Stop checking whether the income was even real. They turned to low and no doc loans, so-called liar's loans, no income, no job, no assets, and they were still willing to lend.
But help me out here. How does that make sense for the lender? It would seem to be reckless in the extreme.
It was, but the key assumption was that home prices would keep going up forever. And in fact, home prices nationwide had never declined since the Great Depression.
People like acupuncturist Rula Giosmas became real estate speculators.
How many properties did you buy in this last 5-year period?
I believe in the last 5-year period I bought about 6 properties.
And what did you buy them for?
For investments.
Along with the mortgage lenders who were profiting from the newly found markets, institutional inventors, who were looking for ways to increase their returns. Since the interest rates are very low at 1%, high-yield products are off the table. Wall Street banks came up with an idea. They got to work offering a high-yielding product mortgage-backed security in combination with CDO collateralized debt obligation.
To understand what a mortgage-backed security is, we need to go over what happens when a bank issues a mortgage. Let's look at how a mortgage becomes an MBS. Tony wants to buy a house costing $500,000. Usually, Tony would go to his bank and apply for a mortgage for $500,000. And in return for loaning this money, the bank would make Tony pay interest on the loan at, say, 8%. Before the world of mortgage-backed securities, the bank would simply keep this loan on its books and receive principal and interest for the duration of the loan, say 30 years. One downside of this arrangement was that the bank had to keep this loan for 30 years, tying up capital and resources. One day, the bank had an idea. It could sell the stream of interest, the 8%, and principal payments from Tony's loan to investors to get it off the bank's books and free up capital at the same time. The bank would make money simply from originating and servicing the mortgages and from other associated fees. In order to sell the interest streams to investors, the bank bundles Tony's loan together with hundreds, maybe even thousands of other mortgages. Then the bundle of mortgages is sold to an investment bank in the form of a single bond. The investment bank partitions the pool of loans according to quality and sells the sections to other investors. So although Tony makes payments to his bank, the loan is actually in the hands of investors. Mortgage-backed securities are essentially a way for banks to free up capital and provide a way for investors to buy into mortgages.
Public investors and investment banks were pouring money in the framework and gaining billions of dollars in profits. The final stage of the greed was the creation of credit default swaps. This worked as an insurance against the failed mortgage debt products.
But they've been very careful not to call it that, because if it were insurance, it would be regulated.
This is actually the security.
This is the selling document for the securities.
Think anybody ever read this stuff?
I doubt very many people read it.
These complex financial instruments were actually designed by mathematicians and physicists who used algorithms and computer models to reconstitute the unreliable loans in ways that were supposed to eliminate most of the risk.
Obviously, they turned out to be wrong.
Why?
Because you can't model human behavior with math.
They are complex, in effect, mortgage science projects devised by these Nobel-track physicists who came to work on Wall Street.
And it didn't stop Wall Street from making billions selling them to banks, pension funds, and other institutional investors all over the world. How big is the market for credit default swaps?
We really don't know. There's this voluntary survey that claims that the market is in the range of 50 to 60 or so trillion.
Everything was working well until 2004. The U.S. central bank started to increase the interest rates. When you combine the increased interest rates and subprime customers with no steady income or a job, it was a disaster. From mid-2006, an increasing number of defaults caused home prices to fall. Homes are now worth less than the mortgage home loans. Many investment banks and insurance companies were unable to pay the money back to investors and went bankrupt, including the giant like Lehman Brothers.
3 or 5 years, those rates reset. They went up, and so did the monthly payment. So a mortgage of, say, $800 a month could easily jump to $1,500.
The U.S. government said it won't bail out Lehman, which last week announced more than $3.9 billion in losses. Shares in Lehman Brothers have plummeted more than 80% in 2008 alone.
Everybody in the West, at least, owns, a lot of people have got pensions, and these pensions invest in stock market, and a lot of the shares are actually the shares of banks. And when bank shares get hammered, people's pensions get hammered, so everybody loses.
Lehman Brothers is going bankrupt after talks to pull them back from the abyss collapsed. And financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black.
This is going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
I don't think anyone really expected a bank as big as Lehman to be in a position that it's in now.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
I'm starting to find another job.
Meanwhile, Merrill Lynch, fearing it could be next, agreed in an act of desperation to a shotgun marriage with Bank of America. So in just 6 months, 3 of the 5 biggest independent firms on Wall Street have now disappeared. Bear Stearns, which collapsed last spring, Lehman Brothers.
Thanks for watching. If you found this video informative, please give it a thumbs up and don't forget to subscribe to our channel for more content like this, and don't forget to hit the notification bell to stay updated with our latest videos.